Start by the concern that Morgan Stanley has raised that investment in ZEE5, which is your new OTT platform, are likely to drag the margins in the near term. Can you just talk about it?
Thank you, Pankaj, for having me. I think, well, let me start by saying itself that the Morgan Stanley report has not been well researched. We will be definitely making investments in ZEE5, but I'm pretty confident that our margins, even up to financial year 21, will remain above 30% plus despite the investments in ZEE5 for the company as a whole.
Right. Don't you think that OTT platform is getting extremely competitive, and that's why investments may overestimate your initial estimates, or you may have to spend more than what you're estimating right now?
See, if you look at my margins without ZEE5, I'm very comfortably able to deliver 36% plus margins. Investing 400 to 500 basis points of my top line behind ZEE5 is more than enough. And also the revenue traction that I'm seeing on ZEE5 itself gives me the confidence that we have more than enough headroom to invest and compete in the OTT space.
Mr. Goenka, hi there. Good afternoon. Thanks for joining in. This is Avan as well in the discussion. And I just want to talk about the overall industry dynamics, because I think what is giving the streets jitters is the fact that content consumption has moved online. There's a lot of internet penetration that we're seeing. Data costs as well are falling quite substantially. And this is a big threat to a traditional broadcaster such as you. So just from that perspective, is the industry worried? What exactly is the outlook?
I think it is too early for people to start jumping to this conclusion. If you look at the latest reports that came out on television, we have seen significant growth across all age groups on television itself in terms of number of households increase as well as the time consumption per consumer. Having said that, we as Zee are playing both the TV and digital game. So for us, a company like Zee, just because our biggest revenue stream today is television, does not mean that we are not poised well to win even in the digital race. So we are going to work our strategy on both of those aspects.
Speaking of the digital race, let's talk a little bit more about ZEE5, which is your platform. Can you tell us what have been the investments that have been made so far for ZEE5, and when is it going to break even?
So as I had stated earlier as well, ZEE5 is a 3 to 5 year journey for us to break even. It could be towards the 5-year mark, and we are willing to invest behind that, keeping our margins still above 30% even in the next 3 to 4 years.
Whenever you talk about any OTT platform, any e-commerce platform, any digital platform, it's always a war going on with the next competitor, because it's a very competitive industry. At what market share are you assuming that you will break even in 3 to 5 years? What's the market share that you are targeting, and how much do you expect the industry to grow by?
We would be looking at being the #1 entertainment app at the end of 12 months from now. And I do believe maintaining that will help us achieve the break-even mark within the time span that I've told you. We are going to look at least 20% plus kind of a market share in terms of revenue on both advertising as well as on subscription from the industry.
So then what about your traditional advertising revenue growth in the medium term? Do you think that has been your largest revenue component for the company? Is that going to lower with the focus on digital?
I don't think so. I think you have to look at it both as TV plus digital. I am pretty confident seeing my numbers that on the advertising front, which as Zee has been delivering mid-teens kind of numbers, even for the current fiscal, it will only accelerate with digital stepping in as well. On subscription side, as I had said, that on the traditional TV side, we will monetize phase 3 this year itself. And I'm pretty confident also that ZEE5 will contribute towards subscription revenue in the fiscal 19 also.
Yeah, you're talking about very long-term growth plans. There was that tie-up as well with Jio. What exactly happened on that front, and what are the long-term plans that you have in store in order to take on competition and, as you said, maintain your margins and your market share?
So with Jio, it's like any other negotiation with a distribution company. We are in active negotiations with them. Hopefully, we'll find an amicable solution. This will only further aid the growth of ZEE5. We do have an agreement with Airtel, which kicks in next month, and you will see numbers coming out from both telcos and independent subscriptions and advertising from Z5.
Right. Mr. Goenka, can you just talk to us about the competitors? Because the list of competitors is pretty huge and, they have, good cash flows. But can you tell us that what will be the differentiating factor for Z5? How will you position it that, likes of Netflix or Amazon Prime content really doesn't matter to your viewer?
If you look at the kind of content that a company like Z produces, we have over 500 hours of content that we create on a weekly basis for our traditional TV business itself. That itself gives us the edge to compete with the likes of Netflix or Amazon. Our depth in the regional market gives us the edge to compete with them in a very well manner. Broadcasting companies will definitely have an edge over other aggregating platforms because of the sheer volume of content that we generate.
So how will you leverage the Z brand on your OTT platform? Because that would give the street a little, help them breathe a sigh of relief in terms of the total investment cost, which will be very minimal.
Well, if you look at our plans that we have put in place for both the free advertising video on demand model as well as the original content and the movie strategy on the subscription video on demand model, I think that in itself should give the confidence to the street that it will be a winner in the next 12 months itself.
Mr. Goenka, thank you so much for taking our time for us. Always good to get perspective from you. That was an exclusive interview.